And when you see these drawdowns, it always feels terrible. And I've been doing this since 2013, and they always never feel great. But the reality is, it's normal. So it's normal in the fact that in the last 12 months, you've probably forgotten this, but this is our fifth or sixth 20% pullback in Bitcoin.
Hey guys, welcome back to Everyday Finance. In this video, Raoul Pal discusses Bitcoin and crypto. Similar to other crypto enthusiasts, Raoul Pal, a well-known macro analyst and former executive at Goldman Sachs, has a highly optimistic outlook on the prices of crypto assets in 2024 and 2025. He predicts that the overall market cap of the crypto market will reach an unprecedented $12 trillion, which is 4 times the current range of $2.65 to $2.7 trillion. As a result, individual crypto prices are expected to soar to new all-time highs. Pal has set a target for Bitcoin to reach a minimum of $200,000 before the cycle concludes in 2025. The significant surge in Bitcoin's value is expected to have a ripple effect on other cryptocurrencies. This is why Pal is particularly optimistic about leading crypto assets such as Ethereum and Solana. The ex-Goldman Sachs executive foresees that Ethereum will surpass expectations. This cycle, the token is priced at $8,000, while Solana is priced at $11,000. Pal holds a generally optimistic view on all crypto assets and technological stocks, considering them to be the sole winners of the exponential age, as per Pal's perspective. Cryptocurrency is an exceptional investment opportunity that has greatly benefited retail investors. It not only allows them to stay ahead of the devaluation of fiat currency, but also offers a unique chance for leveling the playing field, unlike any other asset class. We will now share excerpts from Pal's recent video broadcast, where he discusses his predictions and future prospects for the cryptocurrency industry in 2024 and beyond. And lots of things Raoul Pal discussed, so please watch the video to end and share this video and subscribe our channel Everyday Finance. Thanks.
As I've always said, crypto markets are volatile by nature. It's a 70% volatility asset class. It has deep drawdowns, and it has tremendous upside. In fact, it's the best performing asset class in all recorded history. But with that best performance comes volatility. It's something I warn about in this don't fuck this up thesis, which is don't take leverage. Don't try and trade around or FOMO into stuff. Just be careful what you do and stick to the basics, stick to the bigger tokens. If you're going to degen into stuff, do it in the smaller stuff, because that stuff's much more volatile. Your probability of getting it wrong is very high, although you can get 100x in the space as well. I understand that's attractive to many people, but I'm trying to keep everybody on the straight and narrow. And when you see these drawdowns, it always feels terrible. And I've been doing this since 2013, and they always never feel great. But the reality is, it's normal. So it's normal in the fact that in the last 12 months, you've probably forgotten this, but this is our fifth or sixth 20% pullback in Bitcoin. So you've dealt with this many times before. You just kind of forget it, which is weird. And I think Coinbase put out a super interesting tweet, which was there have been 5 Bitcoin bull markets. In an average bull market, you'll have to survive the following to ride it to the top: 6, 5 to 10% drawdowns, 3, 10 to 20% drawdowns, 2, 20 to 30%, 1, 30 to 40, 1, 40 to 70. And that's all during a bull market. So it takes a certain kind of gumption. It takes an ability to turn off Twitter, to turn off your screens and say, has my thesis changed? Is the adoption of this technology stopping? Is there any other reason that it's going to slow down? Where are we in the business cycle? I spend enormous amounts of time trying to educate you guys that this is a macro asset and it's driven by the business cycle. Just happens to be forward-looking, like technology stocks, and it's driven by the liquidity cycle. So has something changed in the business cycle that would tell us that we're going to have a failed crypto cycle? Well, in all probability, That's a no. So therefore, it's corrective price action. And if you happen to have extra money on the sidelines, use these corrections to add. That's what I did. I was lucky enough to have a bit of cash, and I added to my Solana position. Great.
To highlight the significant potential of cryptocurrency in the future, a chart is shared by Pal that was previously shared by Jurian Timmer, the director of macro at Fidelity Investments. According to Timmer, the chart provides a perspective on the volatility of Bitcoin and illustrates the risk-reward relationship during the pandemic and post-pandemic period from 2020 to 2023. The analysis displays the comparison between risk and reward for various asset classes, including alternative ones like gold, cash, and Treasury inflation-protected securities, TIPS. USD Global and US 6040 and the S&P Index are all significant players in the financial market. However, their influence pales in comparison when Bitcoin is introduced. Bitcoin operates in a completely different realm, with its own unique dynamics. This chart illustrates the risk versus return ratio of various assets, excluding Bitcoin. And here is another chart that includes Bitcoin, clearly demonstrating how the leading cryptocurrency stands apart from the rest. Now, let's return to Pal's video where he discusses the vast opportunities presented by cryptocurrencies such as Bitcoin and Ethereum. Here is another excerpt from the video.
And I've found that compounds really well over time. It's a key way to make better returns out of this space is use the drawdowns to your advantage. Even the big cyclical ones. I didn't sell out of anything last time. I had no intention of it. It wasn't that I missed the top or anything else. I knew that to get back in is really hard. If you take X sum out, you never put X sum back in again. You go smaller because you don't want to risk it all. Your whole psychology is screwed up. So what I prefer to do is say, well, this is a longer term trade. When we get the big drawdowns, I just want to add. And then you compound and you're back to all-time highs well before the market is. And that is really, really a superpower. So what's going on now? Why is crypto so shaky? It's the same reason tech's been shaky. It's liquidity stupid. Remember, I've told everything about this everything code cycle. And those of you in Real Vision Pro Macro and even Pro Crypto, Kevin Kelly and myself talked about it yesterday in Pro Crypto. Liquidity is the big driver of all asset classes and particularly crypto. It's the most receptive to liquidity injections or withdrawals. So I correctly managed to time the bottom in 2022 based around the liquidity cycle. And the forward-looking elements of the liquidity cycle continue well into 2025. So I don't have anything to concern over. So therefore, we're looking at the wiggles in liquidity. And those of you who follow Mike Howell, who's on Real Vision frequently, he also follows liquidity. He's probably the expert on liquidity. And he talks about the liquidity air pocket that I've looked at as well. The liquidity air pocket was happening. If you think about the US liquidity, it's driven by the Fed's balance sheet, which they've been doing QT. So they've been tightening it, making liquidity less available. But that's been offset by the Treasury, by the draining of the reverse repo. The reverse repo is an offset to what the QT was doing. And in the meantime, the other part of the equation is the Treasury General Account, which is the checkbook of the US government that Janet Yellen controls. And she's been building that. But these have meant the liquidity based back in 2022, and it's been going vaguely higher. The everything code cycle taught you that there is no way of financing the debts. It's now become a word people use, fiscal dominance. This is the everything code cycle I started talking 2 years about. The everything code cycle says, well, if GDP growth is too slow, then the amount of debt in the system is too high. So you need either interest rates to come down or you need growth to go up. Now, growth is driven by demographics over time. There's not much we can do about that. You get cyclical growth, but you don't get the overall trend rate growth, which has been slowing. So the available GDP has to pay the interest on the debt between the government sector, that's 100% of GDP in debt, and the private sector is 120% in debt. So we've got not enough GDP to cover the interest payments. This gets really exacerbated when interest payments are high. trend rate of GDP growth is about 1.75%, call it 2%. Whilst interest payments right now are, let's say, 2-year bonds are 5%. Okay. And then if you double that, taking into account the private sector, you've got...
Whether or not you agree with all of Raoul Pal's ideas, it's difficult to dispute some of the points he makes in this video. The world is rapidly changing, heading towards an era where technology dominates every sector. Investors who position themselves correctly now will play a vital role in shaping that future. This undoubtedly involves being a part of the enormous macro opportunity presented by the cryptocurrency industry. What are your thoughts on Raoul Pal's interview? Please share your comments in the comment section. Thanks.